It's time for Yahoo Finance's Market Minute. The major averages are under pressure as investors digest more changes around President Trump's tariff policies. Commerce Secretary Howard Lutnick telling CNBC that Trump is likely to defer tariffs on all goods compliant with the US-Mexico-Canada agreement. Some other stories today we're following. Marvell plunging. That's after its revenue forecast did fall short of the highest estimates. Chipmaker failing to impress investors, looking for a bigger boost from continued AI demand. Meanwhile, Alibaba is launching an AI model it claims can rival DeepSeek. This is the latest development, of course, in that increasingly hot AI race. And Macy's joining a growing list of major retailers issuing weak outlooks as it braces for the impact of Trump tariffs and weary consumers. Same-store sales grew only 0.2%, and that did miss the street's estimates. That's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session.
Welcome to Wealth Madison Mills, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks that you need to know to grow your money. On today's show, Portfolio Checkup, we'll discuss why a long-term investing plan is key to protect your portfolio amid market volatility. And 3 things to know about Apple's new product lineup. Our tech editor will discuss what each product means for the company's bottom line, plus insights for the spring real estate season. An expert will share tips for home buyers and sellers ahead of the industry's busiest season. But first, we'll take a look at some of the market action 90 minutes into the trading day. Stocks pulling back again today amid tariff confusion. This after the major averages saw a reprieve from the sell-off yesterday after President Trump said he would delay tariffs on some automakers. You can see the S&P 500 down about 0.7%. The tech-heavy NASDAQ down about 0.9%, pairing some of the larger degrees of losses that we saw earlier this morning. Joining me now, we've got Tyler Ellegard. He's Gradient Investments Portfolio Manager. Tyler, great to have you. So as investors try to navigate this volatility, you say it's important to have a long-term plan for your investments. How do you develop and stick to a long-term strategy when there's so much volatility in the market?
Well, I think it all comes down to what your risk profile is, because at the end of the day, if you're not willing to take on the risk or you don't like the risk, then we need to dial it back. And so that's where the plan comes into place. And that's really the starting blocks for that, is understanding where does that risk lie? How much money are you willing to risk? Because, when you think about it, what I always try to tell our clients is at the end of the day, put it in dollar terms, right? We can talk about 10%, 15% all day long. But when you put it in real dollar terms for them and you say maybe out of a $100,000 investment, if you lose $15,000, how does that make you feel, right? And trying to elicit that emotion from them, because investing becomes emotional. As much as we want to talk about it being rational, it's very hard to do. And so trying to develop that long-term goal that meets the risk objectives of what they need, but also understanding what are their long-term goals, are they looking to travel, the types of things that they want to do. And so that's really the baseline for that of creating that long-term plan.
And I've talked to some folks this week who are so concerned about the market volatility under this administration that they're pulling out of their investments entirely and looking into just a straight up high yield savings account. How do you rate that strategy?
Not the best. It's when it comes to investing, it's hard to time the market. The more important thing is time in the market. Right? Because over longer periods of time, we see that the market goes up. Yes, some years you get 20%, some years you get -5%. But generally speaking, the market average return is about 12%. So if we're trying to time it, it's a very hard thing to do. And even professionals can't do it. And so try and focus on the long-term plan. And that's really where that long-term plan comes in, is because you need to keep that as your baseline. The last couple of years, let's take it back even further. Let's look at the last 5 out of 6 years, going all the way back to 2019, we've had 5 years that have been 18% or higher in the markets. So that has been a very strong market to be invested in. And so just understanding that you're probably already ahead of your long-term plan. And so it's okay to rebalance and dial back risk, but trying to time the markets is a very hard thing to do.
It certainly is hard. Another thing that's challenging is stock picking, but luckily we've got you to do it for us, Tyler. Talk to me about Broadcom in particular, especially ahead of earnings. What's your base case?
Yeah, base case, I think they have a great report tonight. I'm really looking forward to commentary around their ASICs division. We heard in the last quarter that they're adding 2 more companies to their ASICs division, and Hock Tan didn't want us to include any of the expectations of what those 2 clients could bring to the ASICs division. But yet the company gave us a $60 to $90 billion SAM. So it could be a very good quarter. And I'm really hoping we get some updates on potential growth or ramp for those 2 companies that they're adding for the ASICs division.
And talk to me about Meta, another stock pick of yours. What are you seeing there?
Yeah, this is another AI play. But at the end of the day, when we think about who is actually monetizing their AI, yes, OpenAI and Claude and Anthropic have monetized their models. But from a public investing community, we can't invest in those. And so we have to look to the public markets to see who is the forefront, who is the leader in the AI space. And I really do believe that Meta is there, right? We already heard the last quarter that they're starting to monetize their models. And on top of that, it's not like they're stepping off of the gas on CapEx spend for AI. They're going to spend $65 billion again this year, and I'm guessing it's going to go up next year as well. So they're at the forefront. They're going to continue to invest in this space, and I would be a buyer on this pullback here.
All right, Tyler, buying the dip. Thanks so much for joining us today. We appreciate it.
Thank you.
It's now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Joining me now, we've got Yahoo Finance senior reporter Alexandra Canal. Ali, first up, we're going to talk about BJ's rising on the top and bottom line beat in the fourth quarter. Membership fees and comp sales also a highlight here. You can see the stock soaring here, up almost 13%. Just a terrific fourth quarter. At least that's what the CEO had to say, powered by what he calls all-time high membership results, and also approved assortment of investments in value and significant growth in digital sales. So it's interesting to see that they're accounting that as part of their traffic growth and that membership fee has been so successful.
Yeah, I mean, e-commerce growth at 26%. D.A. Davidson described this as best in class. You mentioned that membership fee. We did see a slight increase in the prices of those fees last quarter, but most strategists on Wall Street said that probably had little impact to do with the results. And in other words, there was a lot of other catalysts when it comes to these membership fees, retention of existing customers, new customers entering the fold, increased penetration of upper tier memberships as well. And then when we think about the guide, that probably leans slightly conservative. We have the back and forth uncertainties with tariffs, the potential impact to the supply chain, but Wall Street saying that, look, BJ's along with Costco, a lot of those other grocers, they're sort of the go-to spots for a lot of these consumers. And even if prices are passed down onto the consumer, they're probably still going to go and shop there. And to that point, Costco does report earnings after the bell later today. We are seeing shares a bit under pressure, down about 0.3%. So we'll see if we get any more updates when it comes to the tariff picture and sort of the uncertainties that some of these companies are thinking through.
A lot of uncertainty right now, and that's also impacting another ticker we want to talk about, Brown-Forman getting a downgrade over at Morgan Stanley after earnings. The analyst anticipates continued muted sales and profit growth amid soft demand and those tariff concerns. Now, several Canadian provinces steering away from U.S. goods, even pulling U.S. liquor from shelves. The CEO of Brown-Forman saying on the company's earnings call that pulling the liquor is actually worse than the tariffs. And I wanted to talk about this morning, Ali, because this was getting some buzz in my personal group chats this morning. Just this idea of Canadians retaliating with their own purchasing power on U.S. goods. That could have a huge impact not only on, obviously, this company, Brown-Forman, but also any other potential consumer goods facing companies as well.
Yeah, they're shopping local. They're taking a stand against these tariffs, taking a stand against this administration. And for Brown-Forman, I mean, Canada only accounts for about 1% of the company's total sales. So they did say that any tariff impact, they'll be able to weather that storm. But to your point, we haven't heard a lot of things that are worse than tariffs. But yeah, if you completely eliminate the option for a sale, that's going to hit your earnings potential there. Now, Mexico, on the other hand, they make up about 7% of total sales. We've seen Canada retaliate on those tariffs, and Mexico TBD. So for a company like Brown-Forman, they're watching the Mexico picture very closely. You mentioned that Morgan Stanley downgrade. Now, it's not just about the tariff picture. We've also seen some softness in this market, some weakness, and when we talk about market share, the American whiskey oversupply. So this is a company where we've sort of been in wait and see mode for a while, and we're seeing shares down about 3.5% today. Year to date, we're down nearly 9%.
Yeah, definitely a lot of pressure there, but also Cracker Barrel. We're going to talk about rising after a top and bottom bottom line beat in its second quarter. They're also raising their full year outlook, seeing 210 to 220 million for adjusted EBITDA, up from 200 to 215 million. A huge move for the stock, up 16%. Allie, correct me if I'm wrong. I feel like we've talked about Cracker Barrel before.
I feel like we did too, because I've only been a couple times, but when I have gone, the biscuits, I love it.
Right, the shavings on the floor, very homey, and clearly maybe consumers craving a little bit of that amid this challenging environment.
And what's interesting is that through Wednesday's close, the stock has actually been down 24%. We are still seeing losses on a year-to-date basis. We're down about 11% with the gain that we're seeing today. But the company itself has been really committing to a turnaround plan. Initiatives have included menu enhancements, operational improvements, strategic pricing, value items, and more efficient marketing. Wall Street is thinking maybe 4.5% comp sales growth in 2025. That's greater than prior consensus estimates. So, a beat and raise is really what investors like to see. And now we're seeing these significant gains today. So, perhaps we should go to a Cracker Barrel and test it out ourselves. That could be a little assignment.
I would love
it. Give ourselves.
On one of our Florida trips, I think that's when we'll go do a little road trip action.
I love it. I'd be down. Yahoo Finance in Florida. Let's do it.
I love it. I love it. A live shot. It'll be great. Allie, thank you so much.
Of course.
Really appreciate you joining, as always. Turning now to the latest policy changes around tariffs. Commerce Secretary Howard Lutnick telling CNBC President Trump is likely to defer 25% tariffs on Canada and Mexico for all goods and services that are compliant with the North American Trade Agreement, USMCA, for at least 1 month. Here to dig into more, we've got Christine McDaniel, Senior Research Fellow at the Mercatus Center. Christine also served as a senior trade economist on President George W. Bush's White House Council of Economic Advisors. So, Christine, you're a great person to speak with this morning. One of the things I'm trying to get my head around, and I know investors are trying to get their heads around, is who might be exempt under this USMCA compliance agreement that Howard Lutnick has been teasing out. Can you help me understand and contextualize which other companies could be exempt under USMCA?
Well, so it's interesting you said that today, because now everyone's going back to the USMCA text and trying to, including us here, trying to figure out exactly what he was talking about. So, the USMCA agreement had a number of provisions about labor and wages in Mexico and Canada, but it wouldn't really be a binding constraint for Canada in terms of, the wages being paid. And then the rules in USMCA weren't so strict in terms of what they could and could not import from China, although there has been some language floated that would, President Trump would want in another agreement that, the whole agreement is up for renegotiation next year. And then also, there's been a number of Chinese companies and so-called foreign entities of concern. And then to the extent any of the supply chains in Mexico are they're doing business with those companies, then they would presumably, not be exempt from those tariffs. So I think over the coming weeks, there'll be a lot of lawyers helping companies comb through that agreement and really figure out, who is compliant and who's not.
Yeah, and Christine, I know I'm asking you to read a crystal ball here, but what percentage success rate would you put on companies' abilities to kind of become exempt in some capacity?
Yeah, I am the worst forecaster. But look, I think that there's been a pretty close hold. I really a lot of eyes on the wage and labor issues. And just looking at how quickly those cases are coming up, and everyone's seeing that. So if you're in Mexico and shipping to the United States, you are definitely wanting to be in line with that. So I'm guessing like at least 2/3. Maybe 3/4 of those companies are compliant with those rules. So, but you're still looking at maybe a quarter or so of companies that may not be.
Yeah, well, it's helpful to have a percentage, Christine. So I admire your projections. Thank you for providing us with that. One other thing that I've been thinking about is the idea of tariffs as inflationary. And for a while, the investors I talked to were worried about tariffs being inflationary. And now suddenly we're worried about tariffs being recessionary. How are you thinking about the potential economic impact of tariffs as at this moment?
So remember, a tariff is a tax, it's a one-time tax, right? So it's not inflationary in the true technical sense. So we have to be careful about that language. I myself make that mistake, but it definitely leads to inflationary pressures. And then of course, as these tariffs keep going up and up and up, like China at 10%, now another 10%, that is also inflationary. And how in terms I'm thinking of it, well, a lot of it depends on how whether he follows through with these tariffs. So there's a lot of tariff threats. Sometimes the tariffs are announced, but then quickly rolled back. And then sometimes, it does end in a deal. But even when it ends in a deal, it definitely it upsets markets, and then businesses who might be thinking about building a new factory or making a new deal with someone. Now they have to think, well, what's the likelihood that I might be facing tariff or tariff threats here, and if it has anything to do with the United States, then that is definitely much higher today than it was before. So it's an investment is a big driver of GDP growth, right? And yeah, I mean, look, this is not good. I mean, hopefully he can get all these great deals he wants to get done, as sooner than later. So the economy can get back to its business of investing, growing, producing, innovating, things that U.S. businesses are really good at.
And how should consumers be preparing for the potential inflationary impact, whether, of course, like you explained, it is that one-time impact? How should consumers still be thinking about protecting their own financial futures amid the potential raise in prices that might be coming?
Well, I mean, the markets are, very volatile right now. So just in terms of the markets, I mean, hopefully, you have plenty of time, several years to write all this out. But just in terms of consumption in the near term, what we're seeing is that I'm seeing more and more people, show up at Aldi, and Walmart, and it's interesting. I'm hearing more and more people who are shopping on Temu, who never used to be, even though it might take a couple extra weeks to get here. So people are, consumers are starting to make their own choices on how to save money here and there, maybe cutting back in certain areas, maybe not taking that trip. I know I just canceled the trip, that we were going to take later this month. So, people are starting to think, oh, do I really need that extra, that extra thing? Do I really need to take that trip? And then just kind of like really focusing on what they really do need and not necessarily what they just want.
All right, Christine, thanks so much for joining us. Hopefully you get a vacation sometime soon. Really appreciate your insights.
Thank you
so much.
Thank you.
Another company facing potential headwinds from tariffs, Boeing. CEO Kelly Ortberg telling employees in a company-wide address today that tariffs imposed by President Donald Trump risk driving up costs for the company. He says the tariffs would mean higher costs for certain parts purchased from Canada, such as landing gears. Ortberg also expressing concern that tariffs could lead to a continuity of supply issue, which he says would be expensive for the company and could impact production. Shares currently lower on the day, down just about 0.5%. Coming up, Apple just released their most powerful computer ever. We're going to break down what you need to know if you're looking to upgrade. That's next on Wealth. Let's get a check on the markets here. You've still got the major averages under pressure, but also when you take a longer look out, you can see just the pressure stocks have been under. Year to date, you've got the S&P 500 down 1.5%. You've got the NASDAQ down nearly 5% year to date. And when you broaden that out to include all of the losses that we've seen following the election of President Trump, you can see even bigger losses on the S&P 500 following that November election result. You can see here we are retracing some of that market momentum that we had seen after that election result. We're also seeing the Russell 2000, that's your small cap index, struggling over the course of this week in particular. You can see that drop of about 2.5% almost off of the back of all of those announcements about tariffs, the idea that smaller companies are not going to be as well positioned to handle the impact of those tariffs moving forward. No surprise to see that you've got volatility spiking today. It's been a very volatile week, volatility going up off the back of that. And then as we have continued to see here, you've you've got your treasury yields continuing to move to the upside here over the course of the week. But if you take a look at today, you can see that movement to the upside as well. Well, this week, Apple announced several new products ranging from updates to some of its most popular devices to updates for its most popular computer ever. It's time for Tech Support, our weekly look at the latest news for computers, video games, and all things tech. Dan Howley is here with the biggest takeaways from Apple's latest. Dan, what do you think?
Maddie, there's 3 new products that Apple announced this week, or 3 sets of products. There's the iPad, the MacBook Air, and the Mac Studio. Let's start off with the MacBook, the iPad Air. That's, the major iPad that everybody seems to be interested in buying. We have the regular iPad that starts at $269. Better processor, and it's really, again, kind of saying it here for itself. It's for people who are upgrading. The Air gets actually Apple's M series processor, so you're going to get more speed out of it. That just means you're going to be able to take advantage of that if you're playing games or you're running certain apps that require a little bit more space or room when it comes to that processor. Then after that, we have the MacBook Air. Now that starts, believe it or not, it gets $100 price reduction. It starts now at $999 for the 13-inch. There's also a 15-inch model. These now get Apple's M4 chip. That's its latest processor. It's for people who are looking to upgrade. There's also a slick blue color that I really like, so you can grab one of those. And then the last announcement that Apple had this week is kind of a twofer. It's the Mac Studio. This is, according to Apple, its most powerful Mac ever made. It starts at $1999. It comes with Apple's M4 Max chip, but there's an upgrade to that. It starts at $39.99, and it comes with the M3 Ultra chip. And this one is actually the one that's the most powerful. I know it sounds kind of weird because it's, well, you have the 4, you have the 3. Why is the 3 more powerful? Just go with it. And you're able to do things like run multi-billion parameter large language models while also running 3D development software, while also running high-end games. So that was just a demo that I saw. Obviously, no one's going to be doing all 3 of those at the same time, but just explain how powerful they are. And just, to give you a sense of what's available when you max it out, you can get 16 terabytes of storage, which is bonkers, and 512 gigabytes of memory. So super, super powerful systems.
One thing I'm noticing, though, Dan, is that these prices aren't crazy, and I wonder how Apple is strategically pricing these items to build revenue. How are you thinking about the impact that these products could have on their earnings?
Well, so the real revenue generator is going to be the Air as far as volume. It's the volume seller, the MacBook Air. That is their best-selling system. You're going to get higher margins, obviously, on the Mac Studio, but they're not going to sell as well as far as volume. And the iPad and the iPad Air, I think the iPad Air is kind of the sweet spot. The iPad is kind of, an entry level at this point. The Air is the one that I think most people would want to opt for because it has a little more power. I think that when it comes to overall revenue, iPad and Mac have been performing better year over year than the iPhone. The iPhone still generates far more revenue than either. It's just that the year-over-year gains that they've seen versus the year-over-year declines that they've seen on the iPhone shows that, look, this is going to help continue to drive that revenue forward and ensure that they get more year-over-year growth, just because every time Apple releases a new version of a product, people go out and buy them, except seemingly for the iPhone, which everyone holds on to for 5 to 7 years at this point, at some point. So I think this is going to do a lot of good for their iPad and Mac segment. That'll help buoy their overall revenue as iPhone kind of, we'll say, struggles a bit.
All right, Dan, really great breakdown. Thank you so much for breaking that down for us. We do appreciate it. Come up, it's technically still winter, but it's time to start planning for the spring home buying season. We'll have advice for first-time home sellers, plus what's changed in the past year since the landmark National Association of Realtors settlement. All of that next. Mortgage applications rose 20% in the past week, according to the Mortgage Bankers Association. As we head into what's typically the busiest home buying and selling season, we've got Yahoo Finance's own Claire Boston to break down. Claire, help us understand the latest numbers here? What do we need to know?
Hi, Maddie. So what's really interesting is we actually have data within this headline number about both refinancings and purchases. Refinancings were up 37%, while purchases were up 9%. And what we're seeing here is this is coming after mortgage rates showed their first big leg down this year. Last week, they were at about 6.76%, and we were stuck in that kind of 6.9 to 7% space for a really long time. Some of this is probably also spring home buying season kicking off. Traditionally, we talk about that time of year being after the Super Bowl, and so it bodes a little bit better for potential buyers. They've got these lower rates, and they still have tough times otherwise because inventory is still pretty low and prices are still very high. So kind of any rate relief is good news for them.
And in March of 2024, we know that the National Association of Retailers agreed to that landmark $418 million settlement that did end the current system of commissions and broker fees. And I know it's been a year since then, which is crazy. Time has really flown over the past year. Talk to me about how we've seen that impacting the industry.
For sure. Yeah, what's quite interesting is that a lot of the realtors I've been talking to have been saying this settlement has not changed too much in the market. The big things that happened are buyer agent commissions can no longer be advertised on those big listing services, what's called the MLS. And buyers must also sign agreements with their agents about fees before they start working with an agent. All of this was designed to bring more transparency into the market around transaction fees and make it easier to negotiate them. But fees haven't fallen yet. Redfin was saying that on average agent fees were about 2.37% last year. That's pretty much unchanged from when the settlement went into effect. And then I think in the long term, the hope is that maybe those fees will come down, but the housing market is just so stuck right now that we're not seeing any big changes, at least right now.
All right, Claire, thank you so much for breaking that down for us. We really appreciate it. Well, new report studying 1,000 first-time home sellers revealed 65% would have accepted 20% less for their home to avoid the stress of preparing it for sale, aka staging, repairs, and the uncertainty around offers. Joining me to discuss the findings, we've got Carrie Wheeler, CEO of Open Door. It's an online residential real estate platform helping people buy and sell homes. Carrie, I found that so surprising that other people are as lazy as me and would take less money to be able to avoid the inconvenience of staging their homes. What does that tell you about how potential home sellers are feeling in this market?
Thanks for having me. Absolutely. The size of that number surprised us too. I mean, 2/3 of sellers saying they would have taken something less to avoid the traditional listing process of getting your home ready for sale, staging it, going through the uncertainty of the offer process, exposing yourself to the risk of fall throughs where 1 in 4 buyers are falling through on contract. And I think it says that while maximizing price for sure is a priority for home sellers, this generation of sellers are also looking to prioritize convenience and certainty, particularly in this market that's been really tough for home sellers.
And talk to me about what you're seeing just in terms of any price relief for buyers. What does that look like?
Not a lot of price relief out there, frankly. But it's interesting, the market reports home price appreciation, and that's on deals that got done in the market. What we are seeing, though, is a whole bunch of deals that are not getting done. So delistings, which are the number of home sellers on the market who are aspirationally looking to sell their home, who have given up and pulled out, that is a decade level high right now. So 1 in 4 sellers are not getting a transaction done and pulling themselves off the multiple listing service, off the market. And so while home prices are going up for those who actually found a deal they liked and were ready to accept, there's a big segment of home sellers who are frustrated by what they're seeing. They're not getting the price we want. And so I think there's more softness to home prices that may be reported today.
And I do wonder also if you can talk a little bit about just the overall housing market in this season that we're in. Is there any benefit to buyers waiting for an off-peak season to buy a home, especially given the interest rate environment, or would you recommend that people get in now?
Our advice for home buyers right now this spring is be ready. The market's very dynamic. We know that even small changes in mortgage rates right now spark buyer demand. We are seeing new listings hit the market right now. This is when home sellers show up, as your prior reporter said. Post Super Bowl, people are looking to list. We find that most sellers are listing in May and in June. So be ready if you're a buyer. Get pre-approved, know your budget, and be ready to make a strong offer when the right opportunity arises.
And talk to me about just home buying in general right now, Carrie, because there are so many headwinds in this environment, so much uncertainty, so much economic uncertainty. What is your advice for home buyers who are potentially weighing the cost benefit analysis of home buying and thinking that they might want to continue renting longer?
I think that's a fair trade-off for a lot of home buyers in the market. And certainly, I do think that the market is continuing to pile up more and more inventory. Yes, the inventory is not at all-time highs, but it's 20% higher this time than it was last year. And the market is slow. Homes are staying on the market for longer. So I think for buyers, just being very attuned to what you're seeing in the market where you're trying to move into, things are shifting in home buyer favor right now. Certainly, they're not in the seller's favor.
Well, let's end there then, Carrie. What advice do you have for sellers navigating that environment?
Similar advice as I have for buyers, which is be ready. What we're seeing right now on the home seller side is increasing competition for home. So be ready. Understand that your home's price and where you list it is your first impression. Those first 2 weeks are really critical to gauge buyer demand. So understand, what the comparable sales look like in your neighborhood, and start with an open door cash offer. We think that's the best way to understand the value of your home and start your selling journey, and you can have more insight then and evaluate all your options.
All right, Carrie, we got to leave it there. Thanks so much for joining us. We appreciate it.
Thanks for having me.
Coming up, how you can think about maintaining your retirement nest egg during political and economic uncertainty. That's next when Wealth comes back. The number of 401k millionaires hit a record high in 2024, rising by 27% to 537,000 over the course of the year. Here to discuss how this record was achieved and how you can think about maintaining your retirement nest egg amid volatility, we have Mike Shamrell, Fidelity Investments Vice President for Workplace Thought Leadership. Mike, thank you so much for being with us today. Talk to me about this growing number of 401k millionaires and people listening who might be envious of folks in that group. What is your single biggest piece of advice?
So we try to point to the millionaires, not so much the number of millionaires that we have, because it's a very small percentage of our overall platform, and not necessarily saying that $1 million is what you're going to need. What we try to do is we try to hold them up as examples of good savings behaviors. So if you look at the millionaires, one of the things that really steps out at you is that they've been saving for a really long time. I think their average tenure is about 26 years. So if you go back, that takes you into the late 90s. And if you really think about all the different economic ups and downs that have happened throughout those 25, 26 years that they've been saving, it really gives you an idea of the benefits of staying the course and taking a long-term approach to your retirement savings. They are also, as you can imagine, they're pretty aggressive savers. So they save a lot. And they're also ones where they're not necessarily afraid of equities. They are pretty, they're invested in the market. And, when you have positive conditions like we've had over the past few years, then you can see the benefit. And that's why we've seen an upswing in the number of people who have hit that threshold.
What does that allocation look like for equities?
So it's up there about, I would say for our millionaires, it's a little bit, you might say a little bit higher than you would expect for some people. Most of these millionaires are Gen X and boomers. And so it's slightly higher. It's probably up around the 75% area. So it's probably, if you looked at what would be recommended for people at that career stage, it's a little bit higher. But again, this is something that has definitely played a role in their ability to hit that $1 million milestone.
Yeah, 75% exposure to equities is great when you've got 2 years of record double-digit gains, but tough in the current environment that we're in with the market down about 5% from its all-time highs. Talk to me about how you coached people through maintaining those gains amid a market downturn, especially for those folks who might be nearing retirement age and are concerned about a market downturn potentially worsening.
Sure. So I'll talk to it in overall, and then we can address the people that are approaching retirement. But overall, what we encourage people to do is maintain a long-term approach to your retirement savings. Make sure that you're taking you have a long-term strategy in place. We recommend people really don't make changes to their retirement savings efforts based on short-term market events. The old saying in retirement, Madison, is put time in the market, don't try to time the market. So taking a long-term approach, making sure that you're not making changes to your allocation or your contribution rate based on short-term market events is what's going to help you stay on track and put you on the best track to hit your retirement savings goals. Going back to those millionaires, think about all the market ups and downs that they've seen since the late 90s. So it's really staying on track, taking a long-term approach is what's helped them, reach the goals and the milestones that they've hit so far. If you are close to retirement, you definitely want to kind of keep the same thing in mind, because even though you may only be 5 to 10 years from retirement, your savings is going to have to last you 5, 10, 15, 20 years into retirement. So you still have a long period of time that you're going to need to manage. And so you want to continue to you obviously want to take preparations in terms of how you want to manage your savings in terms of retirement income, but you still want to take the same approach and stay the course and not make too many drastic shifts based on short-term market events.
What's the biggest mistake that you see people making with their retirement funds?
I would say a lot of it is, it has to do with their contribution rate. So we're seeing very solid contribution rates, which we look at the averages, which is great, but we also try and look at behaviors, Madison, and we're seeing that people are definitely saving at a higher rate. We saw about 30%, about a third of people on our platform last year increase the amount that they were saving. But we do see people that are not necessarily saving enough to get their full company match. The majority of people on our platform, their employer will offer some sort of matching contribution. And so one of the things that we really encourage people to do is make sure that you're saving enough at least to get the full match that your employer is offering. Total savings rate that we recommend is 15%. We understand that not everybody can hit that, so we recommend that people at least save enough to make sure that you're getting your full company match and that you're not leaving, the closest thing to free money on the table.
All right, Mike, got to leave it there. Thank you so much for joining us. Appreciate it.
Thank you.
Coming up, defying cautious retail forecasts, the co-CEOs of On are here with a closer look at the state of the consumer and the sneaker market. You're watching Wealth. We'll be back with that conversation next. On sprinted past estimates in the fourth quarter with stronger than expected sales. The Swiss-based athletic apparel company's gross margin also topping expectations. Analysts on the street cheering the brand's underlying strong demand and robust growth forecast in the year to come. Shares surging nearly 7% on the report, the biggest intraday leap since November of 2024. Joining us now to discuss, we've got Mark Maurer on co-CEO and Martin Hoffman on CFO, co-CFO and co-CEO and CFO. I apologize, guys. Thank you for coming in. Martin, I want to start with you because of just the degree of growth that's being projected here, that 27% potential net sales growth for the year to come. What do you think is going to be the biggest driver of that?
I think the team has done an amazing job last year, so in 2024, in really elevating the brand and the brand awareness all around the world. So we doubled brand awareness in nearly every geography that we're in, and we are a truly global brand. We had the Olympics, which was a big moment for us. We had a partnership with Zendaya, many other great stories. We just had a Super Bowl commercial, which also drove additional awareness in the beginning of this year. And so we have seen an incredible strong fourth quarter, 40% constant currency growth, strong holiday season. And so we go into the year with a lot of tailwind, and I think we have positioned On very clearly as the most premium performance sportswear brand in the world. And so this gives us a lot of confidence for the current year.
And a lot of confidence amid a market of a lot of uncertainty. And I'm curious how you're thinking about the potential impact of tariffs. I think you've positioned the business to not be too overly exposed to China in particular. But how are you thinking about what will happen, especially if your competitors who are going to potentially be more impacted raise their prices? What are you thinking on pricing?
I mean, we're looking at it from two perspectives. One, you spoke about the supply chain, so we're trying to make sure we have a diversified supply chain. We're fortunate that in this case we don't have a lot of almost no exposure to China. So, but we know it could also impact Vietnam. And so if we get tariffs, I think we're positioning On very much as the most premium sportswear brand, as Martin already said, and the products are being appreciated, the innovation is being appreciated, and that gives us a certain pricing power with the consumer. So I think if the industry is impacted, we think On could even be a winner in this space because of how we are positioned as a brand.
How does that translate into how you're thinking about pricing moving forward?
I think we would, in the end, we have to see what's going to happen. But we've proven in the past that we have pricing power in the market because of the innovation that we bring to the market, because of the brand that we are. And if we need, we should have the power to bring prices up. But let's see what's happening.
And from the balance sheet perspective, what would be more beneficial for your goals for growth for the company? Would it be raising prices in the face of those tariffs as the entire market is inflated and prices are rising across the board, or would it be keeping prices low to kind of gain even more market share and get some customers from your competitors?
Yeah, I think, of course, we would prefer not to go into that increased duty environment and basically continue a normal course of business. But at the same time, as Mark said, there's an opportunity for us. It's always a certain time delay before you can react on the pricing side. But again, the disruption is never really good. There's a lot of attention going into that, a lot of time that we could actually spend on building the brand and doing innovation, expanding global footprint, going into more retail stores. So I would rather like to focus on that.
Yeah, and just in terms of the global footprint, I know you had this massive growth in the APAC region in terms of customer success. And it's interesting, even this morning, we've been seeing evidence of consumers in Canada not buying American brands as a sort of retaliation against these tariff policies. We've also seen that playing out in China for a long time with Apple. Are you concerned about that being a headwind on your APAC sales moving forward?
No, not at all. I think the beauty of On is I think we're truly a global brand, which was born in Switzerland. So we got the Swiss heart. We're bringing the Swiss values to the different countries. And I think people are appreciating On for the innovation that we bring, for the premiumness that we bring. And we see very strong momentum in all the markets that we're in. You spoke about it. We got over 100% growth in Q4 in Asia Pacific. And yeah, I think we're focusing on the innovation that we can bring to life and on continuing to expand our own retail footprint as well. And this makes us look very positive into 25.
How do you keep that growth momentum up?
I think we ventured out in many different kinds of sports. We were born in running, started in tennis 2 years ago, and training. We went from footwear into apparel. We just started to expand into own retail. We are now in 50 stores worldwide, so still a very small footprint. If you look at some of our biggest key accounts, we are only in like 30 to 40% of their doors. Take JD, Foot Locker, Dick's. So there is a lot of opportunity for growth, but for us, it's all about the long term. So with the strong brand momentum we have, it gives us the opportunity to control the expansion very carefully. But as Mark said, it's really all rooted in the strong product lineup that we have. And yeah, we have proven over time that we are here for the long term.
And lastly, we've talked about tariffs a lot today, but I'm just curious about how these more direct-to-consumer brands are positioned to deal with policy uncertainty from the Trump administration versus some of your big box competitors. How do you feel that you might be able to be nimble with the policy that's coming in from the White House and positioning?
I think On was born in Switzerland in 2010, so we're now at 15 years. So this is a beautiful, big celebration for us this year. And in those 15 years, I think we went through a lot. So we had COVID, we had the first Trump administration, and we've always focused on ourselves, on bringing the innovation to the market. And I think we've proven that we can deal with uncertainty and that we can deal with turbulences. And we're very, very nimble and fast as a brand. And so actually, these times usually have helped us to gain additional share because we're faster to react on some of these things, and we're very positive that we'll be able to do the same this time.
All right, we got to leave it there. Thank you both for joining us. That's going to be it for Wealth today. Thanks for watching.